When you come to the website linked below, this is research.tradeking.com. This is the website I was talking about. And here we're going to analyze the Coca-Cola company stock symbol KO. So if you can see here, we go to the fundamentals tab, which is right here, and you get all the fundamentals from the valuation to the financial strength to the earnings and dividends. So it shows here that it boasts a 3.29 current dividend yield, which is one of the highest in the industry ranges at the moment. Now it also has an earnings per share growth of 203.7%. Now that's pretty good right there. That's over 100%. That's something that probably most of the industry is not doing. We also see that we have a current ratio that's in the lower portion, not too bad. A quick ratio here, which means that we're having a semi-decent financial strength. We have a return on equity and return on investments that is in the highest of the industry range. Now, when you're looking at a return on, you want to make sure the company has a great return rate. So you want to make sure that it's returning a lot of money based on the assets and equity that it has. So considering that this is in the highest portion of the industry range, that is huge, and that is going to push us into looking at KO as a stock that we want to own. Now, looking here at the book value within the lower portion of the range, that doesn't mean much. It just means that it does have the potential to go up a lot more. Now, the price to book ratio, which is what we discussed, shows if the company is under or overvalued. Well, right now it looks like the stock is overvalued here, seeing that it's in the upper portion of this range. Now, what does that mean? It means that if everything else holds true, we will be seeing that this is a great stock to buy, but we may want to wait for the stock price to come down a bit more to show a lower price to book ratio. Or we will be happy with it and just accept it here and take it as a super long-term hold, and we'll just buy it now. Now, the float is good here. We have a lot of shares outstanding, 4.3 billion. Short interest as a float is 0.8, which means it's under 1%. Short interest percent as a float means that the number of, or the percent of shares that are hoping for the stock to go in the downward direction. So we have under 1% of all the shares wanting to go down. So that's actually not bad. Now, if you see a short interest float of around 10 to 30%, well, that's not good. That means that 10 or 30% of everyone who owns the stock is looking for the stock to drop. And what most people think in the market tends to actually happen. The sales we actually have in the highest portion of the range. That's incredible. We want good sales, and we have a huge net profit margin. This is going to push my final decision to purchase KO as one of the greatest stocks here. Why? Because we have a large number of sales with a great margin of profit, which means it's keeping a lot of that money. In addition to seeing a great earnings per share and a great return on assets, we can now see that, yes, the price to book value may show that the company is currently overpriced at the moment, but overall, we have a great company here that's giving a great dividend at a great price. So let's look a bit more here. If we go into the chart section, we can actually go to a max time frame, and then we can see, okay, has this stock been uptrending over the years? Well, to answer that question, you just say here, has the stock been continuing to push higher? Yes, it continues to push higher. So that is our technical analysis. It's continuing to push higher. So that's what we want to see there. So based off the fundamentals and technicals, we can say that this is a great stock purchase. But now let's compare it to a competitor. PEP here. This is PepsiCo. So if you can see here, the price to earnings is on the lower side, and the price to book value is also on the high side. So this shows that maybe it's just the industry that is overpriced right now, or maybe this is just normal for the industry. So this tells us that because this is also high on the price to book, it may be okay that KO is also on that high point. We can look here and say, wow, it also has a huge number of sales, but our net profit drops a bit. However, you can compare these to each other and do what you'd like, but a lower net profit margin usually means that it has a lot more expenses that it's seeing. However, the return on equity and return on assets is super huge, and the dividend is 3.25. So looking at both of these, you can see here that we have a lot going on, and it may even look like PAP may even overtake based on the ratios here. So again, PEP, now looking at it, may look like a better investment, but again, it's all up to you. Now let's look at PEP from a chart perspective. You can see here over time it's continuing to go up. just like Coca-Cola. So in the end, these are both great investments, but you're going to have to use these to decide what you would like the best. If you have any questions, once again, please comment below, and I'll see you with the next video in this section.